Good morning. Thank you for joining Advisory Live. We're powered by Nasdaq IR Insight, and I'm your host, Will Briganti. Joining me today on the March 8th edition of Advisory Live is Masood Ghaussi. He's a senior analyst at Nasdaq Advisory Services. Masood, great to have you back.
How's it going, Will?
It's going well. Thanks for joining us here at the Nasdaq market site overlooking Times Square, a snowy Times Square. Thanks for coming in.
Thank you.
All right, so today we're going to talk about the equity markets and central banks. So let's kick off with what's going on with equity markets.
Yeah, so ever since the correction that we saw in early February, markets have recovered some losses but has been trading flat. The reason it's been trading flatter is that investors are nervous about a potential tariffs that are being imposed by the Trump administration, and also potential risk of a trade war as in retaliation by other countries.
Right.
The economists see tariff as a tax. On the one hand, although it may help the steel and aluminum industries, across the supply chain it has the potential to hurt businesses and American consumers. So the business community has been pushing back slightly, saying that this could potentially cut into growth, undermining some of the rally that we saw in the markets. As such, investors are nervous, and we're seeing markets trade flat.
All right, so let's switch gears a little bit and talk about what's going on with central banks and remind our viewers about what happened back in February as it related to central banks. So what's going on there?
Yeah, sure. So the Fed has turned hawkish as they're underwriting economic growth. We're finally seeing the first signs of the tax cuts and deregulation kicking in by way of macroeconomic data. GDP growth is kicking back into the 3% level, which is in line with historical norms. We're seeing positive consumer and business sentiment. As such, the Fed has moved towards a more hawkish stance. Interestingly enough, we're seeing interest rate hikes 3 times this year. Markets even pricing in a potential fourth rate hike at around 35%. So expect some normalization by the Federal Reserve. To your second part of the question with respect to what happened last month. So essentially, just to recap really quickly, we're going through what's called the Great Unwind, the end of a loose monetary policy that we've been seeing over 9 years. The result of that loose monetary policy on the negative side is that it has unleashed tremendous liquidity. It has also sapped volatility for the markets. And when we're looking to reverse that by way of raising interest rates and trimming balance sheets of the Fed, it essentially unleashes liquidity. It unleashes volatility and takes liquidity out of the markets. As such, expect more turbulence going forward. But however, with economic growth kicking in, we should see some of this turbulence limited, and this is a healthy process of markets, going up and down.
Yeah, that's great insight. I like that great unwind you mentioned there. So aside from the macroeconomic impact, what has been the impact on corporate America as it relates to tax cuts and deregulation?
Yeah, I think we're seeing 4 things. First of all, we're seeing share buybacks increase. Capital which has been sitting offshore is coming back to America, and corporations are looking to return that to shareholders to be redeployed elsewhere. So that's number one. Number two, we're seeing an increased heightened M&A activity, so more consolidation among U.S. corporations. Thirdly, we're seeing corporations rush to issue debt. As we mentioned earlier, interest rates are going up. So corporations are looking to take advantage of the lower interest rate environment currently. We saw CVS issue one of the largest bonds in the history of corporate America. Right. $40 billion, so it was a humongous deal. It priced well, and there was eager demand, so that's good news. Yep. And finally, on the earnings front, we're seeing high single-digit growth high single-digit EPS growth consistently over the last few quarters and going forward. This quarter, we're seeing EPS growth of in the teens. So all around, very positive momentum. In corporate America, we should continue to see growth, organic growth that is, and as capital is being returned and redeployed, it will be redeployed into new ideas, new businesses, and new ventures. Right,
and of course that CVS bond, there was certainly a catalyst there. They issued that bond to fund the recent acquisition.
Yes, of Aetna, correct.
Right.
Yep.
Okay. Last question,
yep.
Masood. So I know that you and the team at Nasdaq Advisory Services, you primarily conduct shareholder surveillance. So what are some of the trends that you're seeing recently as it relates to fund flows?
So when you look at the investment outlooks of some of the largest active managers, the likes of Wellington, Fidelity, Capital Group, a lot of them are looking at international markets. They do acknowledge the fact that the U.S. markets are growing. However, valuations are stretched in and around 18 times PE. And as such, opportunities are limited. So expect sector rotation within the United States, more capital moving away from the defensive sectors, the likes of utilities, which has taken a strong beating, and into the likes of financials and other growth sectors and small caps, and money also flowing into the international markets. In terms of sort of taking a step back, we continue to see more money flowing into passive index investors and them gaining market share.
All right, awesome. Terrific insight, Masood, as always. Thank you so much for joining us today.
Thank you, Will.
All right, great to have you here. Ladies and gentlemen, this was Masood Gausi. He's a senior analyst with Nasdaq Advisory Services here in New York. For more information on our investor relations solutions, be sure to visit our website. That's business.nasdaq.com, and we'll be back to you with a new edition of Advisory Live later today with a guest from our London office. We're going to talk about the Italian economy. Thank you so much for joining us.